Welcome everyone to the Wealth Management Review for Daniel Krug and Associates. Today's date is April 7th, 2022. Our presentation is titled Stay Invested, Stay on Track. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me in this presentation. This information, as a reminder, is for informational and illustrative purposes only. If you have any questions specific to your situation, just please give us a call in the office and we will help you with that. Our agenda for today, we're going to be going over an update on inflation, looking at the economic impact of the Russia-Ukraine war, talk a little bit about where we're at in the economy and market, and then talk about investor behavior during volatile times. And then we'll have a short recap of everything we went over. So,
wow, that's a pretty big list. We got a lot to do here, don't we?
Yep. So why don't we just dive right in?
All right, that
and
sounds
we
good.
can continue talking about it as we go. For an inflation update, a couple things I want to point out first is that where we're basically seeing the most amount of inflation is in the transportation category. When you look at these charts, even the chart on the left, even though transportation seems to be lower than energy, it is actually a bigger component of the total consumer price index. Looking at the chart on the right, you can see that transportation is 14% of the total, where energy is 7%, so it's twice as big. And when you're looking at really where the headline inflation is coming from, it is really in the areas of energy, transportation, food, and beverage. You can see things like shelter and medical care are lower than the current year-over-year inflation rate of 7.9%. But understand what shelter represents. It's actually the cost of maintenance and keeping your living going forward, as opposed to the price of homes. The price of homes has really shot up, and we all know that. But that, however, is considered from a consumer price index standpoint, that's an investment. It's not a cost that's tracked on a monthly basis as far as how much you're spending out of your pocket. So we can see the headline inflation is mostly coming from energy, transportation, food, and beverage. Now, how is that going to play out over the rest of the year? And that's what this chart is showing us. The left half, the dark blue, kind of represents how inflation has gone month by month on a monthly basis, ending the year at that 7.9% year over year in higher inflation. Where we're at right now is still in that range of about 8%. And what we're forecasting to have happen moving forward as the Fed raises interest rates, we believe that will cause a slowdown in the growth of the economy, which is needed to bring inflation into check. And what they're projecting right now, based off of the assumed rate increases that are planned by the Fed for this year, to try to get that down to somewhere around 5% before the end of the year. So that's something we've got to monitor and see how that's going to play forward with everything that's going on in the world. So the question is monetary tightening, is these Fed rate increases going to really hamper the stock market? And what this chart is showing us is that basically, on average, stock returns have historically been positive in those first 2 years of Fed tightening cycles. The left side of the chart shows that if the Fed is tightening, on average, the S&P in the first year of Fed tightening is still up on an average of 7.8%, a decent rate of return. In the second year, however, it drops down to be an average of about 5% if the Fed is continuing to tighten in that second year. The two bars sections on the right, first, no recession, so this means that we're actually in a growing economy and the Fed has to tighten. The stock market does even better because the economy is strong. averages 10.1% rate of return, even though the Fed is increasing interest rates, and the second year even turns out to be better. So it doesn't stifle growth necessarily. It allows the economy to level off and corporations to still maintain profitability. When you look at the last group of bars, that is the recessionary cycle. So what this is saying is the Fed is raising interest rates while the economy is shrinking. And you can see that is not as good. We've got a 5.8% average in that first year, but it drops down to 3.4% on average if we're in a recession in that second year. Right now, we're not in a recession, so that's a good thing to know moving forward.
Well, you know, it's really kind of interesting because if you look at what's going on with the economy today, we're not in a recession, even though they're raising the interest rates right now.
Right.
So it is more likely, from an economic and a market standpoint, for us to have a relatively decent year this year, even with them starting to raise the rates
Right.
up a bit.
If the economy stays strong, continues to expand, it could be a positive in the long term.
Yeah.
To get things stabilized and hold off inflation getting out of hand.
That's really interesting because there's just so much going on out there right now, and I know it is a bit on the disconcerting side for a lot of people, but from a market standpoint, I don't think we're really having too much of a problem.
Right.
So let's go ahead and talk a little bit about Ukraine and Russia and how that's impacting the economy and the markets as a whole.
Okay.
So when we look at this chart here, this talks about the global impact of Ukraine crisis and how it is expected to be very uneven across the board when you look at it from a world standpoint. The chart on the left-hand side really shows the potential GDP shock from the war. And it's very uneven again. You know, if you look at the world as a whole, the year-over-year percentage point change to real GDP, the real growth, from the world standpoint could be anywhere from negative 0.4 to a negative 0.9. And that really determined by how long this is going to go. And is it going to spread? Now, there's a lot of talk out there right now. No one really knows which way it's going to go. But they've already baked in both scenarios in these charts. You look at the U.S., on the other hand, it could be anywhere from a negative 3 to a negative 8. Who gets hit a little bit worse? Well, when you get over to the European Union and you look at what's going on with France and Germany and how much they rely on Russia and Ukraine from a GDP standpoint, that's where the damage can be done from a portfolio standpoint because it will hit their GDP. So, you know, when you talk about investing, Rocky, it really does make sense to stay closer to the U.S., possibly the U.K., than going over into Europe because they are expected to be hit harder. You know, when you talk about it from an inflation standpoint, how is Russia-Ukraine war going to affect inflation? What's the impact? Well, from a world standpoint, they're projecting that inflation will be up about 2.5%, and with the U.S., around 1.4%. And this is as long as this goes on. When it stops, which it will, they all do, you'll see that things will get back to normal again.
Well, it doesn't feel that way, but it sure looks like it's not as big of an impact long term to the U.S. like it is the rest of the world. So we're getting buffered a little bit from that. I think some of the issues are, since we're in inflation, it's like been an adder to what's already been starting, you know, through inflation that's taken place in the United States. So
yeah, I agree. And then let's not forget also that we're coming out of earnings season, and it was a volatile earnings season. I mean, you had highs and lows with different companies, good reports, bad reports. So it all plays together, and actually, you're going to be talking right about that, aren't you?
Yep.
Okay, so let's
so
go
we
ahead.
can move on and start talking a little bit about the economy and the markets. When we look at where we were actually, let's go back a couple months. Where were we in February looking at the leading economic indicators? A lot of green. Remember the charts, when they are green means that it's a positive trend in the economy. When they're yellow, it means it's kind of neutral or cautionary, something that we have to keep an eye on, but is not necessarily negative yet. If it's red, that means it is negative. The trend on that is not moving in the right direction. And we've been this way for a while, looking at geopolitical risk being red. The equity market valuations have been high because we've had a good run up in the market the last few years, and we bounced out of COVID pretty quick. I think it took only like 4 months to recover the S&P from the low in March of 2020 to July of 2020. The political environment has been dicey, and that's why that's cautionary. But everything looked pretty good a couple months ago, and then inflation continued to go higher, and the war with Russia invading Ukraine took place, and see how that impacts what those forward-looking indicators are telling us as of today. So monetary policy went from green to yellow. Why is that? The Fed actually did start raising interest rates. So that is a sign that things are, we have to keep an eye on it. We have to watch how they're doing it. If they do it too fast, it can cause the economy to slow too much. If they do it too slow, it doesn't tame inflation. So we're watching that. When you raise interest rates, it's going to impact the yield on bonds. And that's that second yellow on the first line. So there's a lot of instability in there right now. On the second line, interest rates, which is the result of Fed policy tightening, is going up. So it's not as conducive for businesses in the future. So it moved from green to being caution. So not necessarily a negative trend yet. It's how they do the raising of the interest rates, but it's something to keep our eye on. On the third line, you've got international economic outlook. Obviously, with the war with Russia and Ukraine, it's impact energy and food and things like that across the globe. So that is a concern, something we're watching. Inflation is continuing on the bottom line. So that we have to make sure they get that in line over the next year going into 2023. And the energy costs, we're all feeling it. We all see it at the pump. Thank God it has moderated a little bit, but it is still, compared to where we were just a few months ago, moving in a different direction than what we saw before. So, and no change to equity market valuations or the geopolitical risk. One of the things that we watch that we don't report on a lot is actually this chart that talks about the overall stress in the markets. Is there limited availability of financing? Is the market valuations so high or so low that the stock market is not in a good opportunistic position to make money? And the chart on the right is basically showing us an average line that is a gauge to say, hey, if it's over 5% stress related into the financial markets, that it's a concern. If you go back and look at March 2008, look at that huge spike. Everybody remembers the Great Recession of 2008 and 2009. Everything was shutting down. We were in a recession. There was limited availability of funds for companies to borrow to get going, so on and so forth. It had a huge stress on the financial markets. Then again, closer to the very end of the right side, that spike, that was COVID. We were shutting the economy down. We did not know if companies were going to be able to pay their bills on their liabilities and things like that. So that was a huge stressor in the market. But if you look at where we're at now, even though it's ticked up, we're still well below the 20-year historical average. So the markets are not overstressed, especially from the credit side. When we look at the left side of this now, we're talking specifically about high yield bonds. They've had a negative return this year. But the question is, where is that coming from? Is that from limited availability of credit, or is it from more of the fact that there's a interest rate increase going on? And we're saying the majority of that is from the rates going up. 4.03% versus 1.65 due to additional stress in the credit markets. So it's still coming from the actual interest rate increases that are starting to take place versus other factors in the market. Another way to look at this is what kind of default rates. That's the concern with high yield, is they're the most riskiest bonds out there. So where are the default rates as far as corporations not being able to pay their bills? And you go back to COVID, and you can see after COVID hit in like February, March of 2020, look at how the default rates started going up. Okay, we went over 6% default rates in the United States, looking at that top blue line for a short period of time, but the government stepped in. We did things to make liquidity available at zero interest rates. There was a lot of recovery acts that took place to infuse money into the markets, and the default rates dropped off and are at historical lows even today. So we don't see, from the credit market side, a huge problem going on right now with everything else, with the war in Russia and the rising interest rates and high inflation. We don't see a high default rate coming yet, which tells us from a credit side the markets are strong. When we look at some other fundamentals and we look at it relative to where we were with pre-COVID, pre-pandemic, which is that dotted yellow line. Look at all these different areas. Real personal consumption expenditures, industrial production, employment, household net worth, so on and so forth. How are we today compared to where we were before the pandemic? So if we look at the dark blue line starting at the very left, real GDP dropped about 10% in that COVID drop period from the pre-COVID period, the yellow dotted line. Where are we at today? We're actually ahead of where we were pre-pandemic. Okay, and across the board, you look all the way across the board here, even though things had dropped because of COVID, look how many different areas have recovered and gone beyond where we were before COVID. So this is telling us overall the fundamentals of the economy are strong along with those credit markets.
Those are some pretty impressive numbers, especially with everything that's been going on.
Yeah, so if we can hold this, if the Fed does their job and doesn't do things too fast or too slow, and keeps us on an even keel, hopefully we can bring inflation into check, because the economy basically is strong. Let's just not tank it.
Right. Well, it's really interesting because you've got a weird situation going right now with the fact that we have such a strong economy, but yet they're trying to slow it down.
Right.
Which is not what you normally see in a recession, right? So it kind of signals that the recession isn't the issue here.
Right.
So it is a different situation for the Fed to have to handle, but Powell's done a pretty good job so far with the Feds in the direction he's taken everything. We'll see how he does with this new one that comes up.
Right.
So that's all good. That brings us really to investor behavior. And it's been a while since we talked about investor behavior, but think about what's going on in this world today. All the news, it is creating, unfortunately, a lot of fear of the future. And as we had talked about, things are looking pretty good from an economic and a market standpoint, but there's still that fear out there. I hear it from our clients. You take that and you think about emotionally based decisions, and those two as a combination together, it's kind of like this. Ammonia, bleach, it's not a good combination. Nothing good will come out of that. And what I would like to talk about is behavioral finances and what happens with clients that really allow their fear and emotions to take control of their decision making. And the good news is our clients are pretty stable when it comes to investing. But for anybody out there who is not with our firm, you might find that it's a little bit touch and go out there for you. But we're here to tell you that there's a safe haven if you do investing the way it should. So think about these statistics here. The average investor earns below the average market return. So if you look at these numbers from 20 years ago, ending 12/31/2019, the S&P averaged 6.6%. Is that a great number? Well, if you think back 20 years, we had the lost decade from 2000 to 2010, where many people just didn't make any returns at all, but then the following decade did pretty decent. When you look at the average investor's return from the market, it's at about 4.25%. Well, that's considerably lower than what the S&P 500 did. And we're talking about equity investors, not bond investors, equity investors. Now, why is this occurring? Well, because if you leave it to ourselves as individuals and we read the news and we get fear and we start making emotional decisions, the behavior becomes, in very many cases, illogical. What we're going to talk about a little bit today is some of the factors that come into play, and then we're going to re-baseline ourselves as to what are we supposed to do in the markets to be able to get that long-term return that we want to get. Let's talk about the behavioral finance instances. We'll start out with the availability bias. Buy a stock after reading positive articles. It's really kind of interesting because as an individual, we really do, even with the internet, we really do have a limited amount of information that pertains to whether we should or should not buy a stock. And that creates a little bit of availability bias. The information that we get can be one-sided. It's important to understand that there is a bias out there. When you hear news, it sounds positive, and now you want to jump on the bandwagon. Then you've got hindsight bias. Now, what's hindsight bias? Well, it's where you believe you can actually predict the future based on the obviousness of the past. And Rocky, I think we've talked about this before. When it comes to looking at news or charting or whatnot, the trend is your friend until what? Until it ends, right? And then it can be disastrous. And when you're talking about really buying and selling assets based on events that you believe will happen, you're really kind of guessing as to what the market's going to do. And that's what can get many people into trouble. You look at the third category, confirmation bias. Well, this is where you get over concentrated in one company stock. So effectively your portfolio is going to live and die by that stock. And what happens is you're really unprepared for a potential stock decline. And unfortunately, it makes your portfolio very undiversified. We've talked about things before where we want to stay diversified in the portfolios as much as you can because that protects us. Let's go to the next one. Sell stocks that are recently down. Now here's where recency bias comes in. And you base your decision on recent and limited data. You focus on trends rather than fundamentals, and you ignore proper asset allocation. This is where people really get in trouble. And again, it's the emotional buying based on the limited information that creates these biases that have gotten so many investors in trouble and, unfortunately, a limited rate of return based on what the market's giving. Let's look at the behavior of thinking in action here. The blue line here is really this, we'll just call it any given stock. The first phase here, when you're looking at availability bias, you can see the market's been going up. After reading the positive news, you decide, you know what, it's a no-brainer to buy this stock, so you buy into it. typically what happens is the market's been running up for quite some time on that stock before you get the news to, hey, it's time to buy it. Then you got your confirmation bias. You know, you might even get a negative article that isn't clearly important to what you believed previously when it comes to this stock. So you hold on to the stock, even though there might be negative news that says maybe you should get out of it. And then what happens? Well, the market goes down, the stock goes down, and now you've got some hindsight bias. You know, you look at the stock you bought and you say, well, you know, wasn't that downturn obvious? Yeah, it kind of was. The market's okay though, the stock's okay. I bought it and I know it's a good stock, but what if the market was in the need of a correction and that position was in a need of correction? Now you've gone down from where you purchased the stock and you're feeling kind of tense about losing the percentage that you have. Well, that takes us to the loss aversion bias. You know, this is where you're looking at the stock, you're looking at the amount that you've lost, the stock's going down even further, and now you're really worried and you end up getting out of the stock. And at that point, you plan on staying out of the stock market for a while after that lost in that one position. So now we're out of the market. So emotions are really kind of taken in here. There's a lot of biases that brought us to this position, but now the market starts taking off again and the stock takes off. And you're watching it going up, and it's going up, and it's going up. So what happens then? Recency bias comes in. Well, the market has been going up for such a long time. It's in good position right now. There's no reason it could be turning down because everything's so positive, so you buy back into it. We kind of went against the basics of investing, didn't we? We bought high, we sold low, and then we bought high again. And these are the traits of someone who is more emotionally investing and not really looking at the fundamentals of investing as they move forward. If you think about this chart here, this talks about the short-term volatility and how normal it is year over year over year. So let's talk about this chart. You've seen it before, we've talked about it, but I'm going to go over it one more time, and I want you to think about these biases when you look at this chart. If you look at the red squares, that's the intra-year declines in the market, and it shows how far down it goes sometimes before it actually ends up up. And what do I mean by up? Well, now let's take a look at the blue bars. That's the calendar returns at the end of the year. So you can look at any given year here, and there are so many where the market had gone down 5, 10, 15, even 18%, but ended up at the end of the year. Matter of fact, about 75% of the time it ends up, which means your odds are better if you just stay invested than if you pull out and then try to time pulling back in again. So this chart should really let you know that the odds are with you as long as you stay in the market and stay invested. And I'm really proud of our clients because they have not called up and said, hey, is it time to get out of the market? No, they understand. They understand markets are cyclical. They understand that they're volatile. And they also understand they have long-term horizons and they are on track to hit their targets. So that's a good thing. So let's go back to the 3 fundamentals of investing. Well, first one is own equities. You should have a portion of equities in your portfolio. Number 2, diversify in multiple sectors and asset class. That gives you a more safety and less downturn in your portfolio when there is a correction. And then the third one, which is extremely important, is rebalance the portfolio often. And I think that's the area that many people get in trouble with is the rebalancing. I mean, we do it at really 3 different levels with our portfolios. If you think about it, you know, if you've got exchange traded funds or mutual funds, they get rebalanced literally daily. If you have a portfolio manager that's managing the portfolios, they're going to rebalance that at least quarterly for the portfolio. And then you have it as the family of portfolio level where we're rebalancing the portfolio and risk to make sure that the goals that you're shooting for are still going to be hit, and the downside threshold, in other words, how far your portfolio can go down in the worst market conditions, doesn't breach that threshold. So there is literally 3 levels of portfolio management and rebalancing that we do here at Daniel Krug and Associates to make sure our clients stay on track. Anytime we have a healthy correction like we're having right now, and I know it doesn't feel healthy, it's kind of like doing push-ups. Push-ups are healthy, but they don't feel good when you're doing them. Well, we're in the middle of our push-ups right now with the market, but it is a healthy correction that we've got going on right now, and we have clients taking advantage of the downturn with Roth conversions, like Rocky said, and rebalancing to get the upside with greater growth in the portfolio. So life's good. Just got to stay focused on what's important right now. Right, Rock? Yep. Okay, so I'm going to go ahead and pass it over to Rocky.
Now can I recap things? And
Yep.
go on from there.
That. So you can go to the YouTube site where we are and look through it and kind of peruse the videos there. An easy way to get there is just go straight to our website at mydkna.com. You click on Watch Us, then you can go straight to the DKNA YouTube tab, or you can watch videos on our site itself. There's also snackable videos on there, which are like 3 to 5 minutes. But it's a great place to get more information when you actually have the time to sit down and view those. Good site. We got a lot of information there for our clients. And that kind of wraps it up.
You take care of your family?
And we will take care of you. We are ready for the future. We're ready for 2022 and beyond. And we'll see you next time.